Hello there. Thanks for joining us on The Open on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Enbridge has increased its dividend by 3% and stuck with its growth forecast in its 2026 financial guidance. The Calgary-based pipeline giant has $8 billion worth of projects entering service in 2026. It also expects strong growth from recent rate settlements and rate cases in gas distribution and gas transmission. Last month, the energy company approved a $1.4 billion U.S. expansion to boost deliveries of heavy oil. Toronto home prices resumed declines in November amid slower demand. According to data from the Toronto Regional Real Estate Board, sales in Canada's biggest city were down nearly 16% year over year. And the benchmark home price was also down, dropping almost 6%. Stagnation comes as tariffs imposed by the U.S. are deterring consumers from making big purchases. Hiring at U.S. companies has dropped the most since 2023, according to the ADP National Employment Report. In November, private sector payrolls decreased by 32,000. This comes after private employers added 42,000 jobs in October. The latest week numbers are increasing concerns about a more rapid deterioration in the labor market ahead of the Federal Reserve's meeting next week. There is a look at the TSX yesterday, trading near records but slipping slightly. Did we look at the U.S. futures? We should have a quick look at those. It looks like we're going to get a broadly stronger open for the U.S. market, although the NASDAQ under pressure. Let's have a look at oil now. Amid concerns that Ukraine is seriously damaging Russia's oil export protests with continued attacks. You can see oil up about 1%. Let's have a look at gold, which has rallied over the past few sessions, and it's up again today, not far short for the February futures, not far short of $4,300. US announced. Let's check in on our currency, the Canadian dollar. And there you have it. It is up as well, as you might expect, with an anticipated rate cut south of the border next week. And let's finally have a look at Bitcoin, which has had a miserable few weeks, holding its own today, and it has bounced off the lows of late November, however, way down from the record of just a few weeks ago. Canadian bank results are still rolling in. Royal Bank posted a jump in fourth quarter profit and lifted its dividend. And National Bank says its fourth quarter was boosted by strong wealth management. Let's get more from Tony Sierro, President and Chief Investment Officer at Caldwell Asset Management, a division of Caldwell Securities. Tony, thanks for joining us.
Thank you, Andrew. Pleasure being on.
Did anything jump out for you with these Royal Bank results?
Fantastic results. We were expecting that, particularly the capital markets and wealth management, where we've seen the most growth. The other sectors, the personal banking side and loan growth, we can see that a little bit under pressure going forward. The personal banking, as banking fees come under scrutiny a little bit more, and loan growth, direct reflection of the Canadian economy. You mentioned earlier that the housing prices and costs are coming down, so loan growth will be stagnant and potentially the provision for credit losses will increase. But the capital markets and wealth management, that's the area going forward. And if you can hone on that, you definitely have potential good growth going forward.
That's interesting. Sorry, Tony, I cut you off there. You refer to fees. Do you think, the budget, as you know, referred to the government's desire to improve competition in banking. Do you think the banks will be under scrutiny over the fees they charge?
I believe so. You're seeing on the investment side, fees being more transparent. So I believe something will be done on the personal banking side. And not to get into details or as far as we know, but if you see a creation of a stable coin currency that's backed by the Canadian dollar, stablecoin will make everyday banking more efficient, wiring transactions at zero cost. So things like that could put pressure on personal banking side.
The banks will resist that. People doing anything at zero cost.
Exactly, exactly. And one thing I do want to mention on the dividend yield, they increased by 6%, and that's the quarterly dividend payout. And if you factor yesterday's price, the new yield will be about 3%. So that dividend hike of about 6% on their quarterly dividend will lead to about a 3% dividend yield. And that brings it back to within the minimum standard. If you're looking at some investors living on the dividend yield, 3% is acceptable. So that's quite positive as well for the bank. So I'm glad we saw a dividend increase of bring it back around 3% overall.
That's interesting, but it's not really much of a yield, is it, compared with some of the pipeline stocks? Or you can do better even with a name like Canadian Natural Resources. It's not that generous, 3%.
Exactly. And again, I've only secluded the investors looking at investing for dividend yield. Overall, though, you have to take the company Royal Bank in itself and its growth outlook going forward as part of the equation if you're making an investment decision. But vis-a-vis the National Bank, which increased its quarterly dividend by only 5%, we anticipated a 6% increase there as well. And that 5% dividend increase only means it still will be below 3% on the dividend yield on the stock. And that might not hit the criteria that some investors are looking for from a yield. So National Bank came out with very strong earnings this morning as well. Capital markets was an area, so was wealth management. So trending in the right direction. And earlier this year, the acquisition of Canadian Western Bank, you can see that acquisition filtering down to the bottom line as well. However, though, the dividend yield was a little bit of a disappointment. We anticipated a 6% increase. I'm not sure that will affect the stock performance today. I think it'll do well as Royal Bank, but a little bit disappointed that the yield wasn't increased a bit higher.
So you'd be inclined with new money to buy Royal Bank, but National Bank is a hold for you right now?
Yes, and there's a couple of reasons for that. Royal Bank, we like the acquisition of HSBC Canada it did last year. Now, even though HSBC is a bank in Canada, it has the global capabilities. So Royal Bank, the explicit revenues, you see them right away. So reduced costs, bringing on more revenue streams by the acquisition. But the implicit revenues that you can't see are what we anticipate going forward. That intellectual property you got from a global wealth manager will reflect down to the bottom line of Royal Bank as it enhances its scope, more of a global investing bank versus just a domestic bank. So we think those implicit reasons, intellectual property acquired vis-a-vis HSBC Bank Canada will do well going forward. Also, Royal Bank raised their profit forecast for next year, the profit targets for next year, and that's quite good to see. Royal Bank is the Canada Bank. It's the People's Bank in Canada. Our economy seems to be in a little bit of a rut, but however, Royal Bank continues to raise their target, which is pretty positive.
Give us your take finally, Tony, if you would, on gold. What kind of a weighting are you holding in your portfolios in bullion?
On the high end, it's 5%, and the more conservative end, it's about 2%. And the reason why we're doing that, it's a direct hedge if you continue to see a weakening of the the U.S. dollar. There's all kinds of political pressure on the U.S. dollar to weaken it. You want to improve your exports and you want to buy more domestic, so you weaken your currency to do so. And gold, because it is valued in U.S. dollars, if the U.S. dollar becomes weaker, the price of gold will need to appreciate. It also is not always, but historically there has been times when you saw market volatility and the price of gold stabilize or increase. So for us, it's a way to mitigate some portfolio risk, but also to mitigate some of the political pressure of declining US dollar.
Thank you very much, Tony. Really appreciate it.
Pleasure, Andrew. Thank you.
Tony CRO, President and Chief Investment Officer at Caldwell Asset Management. Coming up, Crowdstrike, the big player in cybersecurity, just released its results. We'll drill into those after the break. Crowdstrike has raised its forecast for the year ahead, signaling resilience in demand for the company's portfolio of AI-enabled cybersecurity products. Let's get more from Peter Weed, Senior Analyst in Cybersecurity at Bernstein. Peter, thanks very much indeed for joining us.
Thank you.
Peter, I think your thesis on Crowdstrike, great company, reliable, but just the stock price too rich for you right now, and you have a hold rating.
Yeah, I mean, it's a frustrating thing given the quality of the business. It's one that has performed very well, and I don't see a reason why that should change looking forward.
What is different about Crowdstrike versus, say, a Palo Alto? What's distinctive about them?
You know, both of them are really good businesses. You know, they target maybe a slightly different buyer. You know, Crowdstrike, if you think about it, they've really emphasized a strong integration of their platform, all working together very seamlessly. The end benefit of that, as you might imagine, as just a user of technology on a daily basis, is that the operational effectiveness of it can be quite high. Palo Alto tends to be much more about a very broad platform and much more like hand-holding for customers that may feel more overwhelmed and have fewer internal resources to get things done. And so they both kind of serve a customer in their own way, I guess.
I see the CEO, George Kurtz, using it sounds a bit military, even this jargon, but he says artificial intelligence is expanding the attack surface. And he says that includes adversarial nations, including China, as a source of threats.
Yeah, I mean, if you think about it, and one of the areas that, you know, Crowdstrike is really trying to play a leadership role in is as companies are adding AI capabilities that they're exposing both to their employees as well as externally, how do you make sure that those are not exposing, you know, intellectual secrets, exposing financial secrets, or even providing new routes to break into organizations? And obviously, this is all very new, but it is something that is, you know, a top of mind problem for IT and cyber organizations in every large enterprise.
Yeah, Kurt says, I love his Silicon Valley jargon here. He says, just as anyone can use AI to vibe code and become an engineer, anyone can now also vibe hack, becoming a sophisticated adversary. What does he mean by vibe there? Have you come across that expression?
Yeah, you know, it's a funny word, and it really kind of emerged earlier this year, and it has to do with, think about, there's these code tools out there that you can literally just in plain English ask it to do something. Well, as you can imagine, particularly in the, you know, adversaries in this world of hackers, many of those people are maybe not as sophisticated when it comes to using technology. But if you can just ask a piece of code to write something that can attack and take advantage of maybe a security hole in an organization, or emulate somebody's boss and try to make them seem like them. Wow. That just creates a massive problem. And AI is enabling in many ways, you know, these, you know, criminals and bad people to perhaps be more effective than they were before on trying to break in.
So what kind of customers does Crowdstrike have? I mean, are they big corporations, small and mid-sized?
Yeah, I mean, the CrowdStrike emerged originally selling to large enterprises, but with that kind of very easy to use platform that's well integrated together and being particularly well suited for Windows environments, as you can imagine, it's not just the large enterprises that have that need. They have been really expanding their access through managed security service providers into the small and medium businesses as well, and even have direct purchase ability. Even as an end user, you could go purchase their endpoint security directly from them. And so part of their strength has been going from, say, the 20,000 largest companies in the world, they're getting into the, 30 to 40,000 customer range now, which shows that they're able to start to go into the mid and smaller market as a growth factor for the business.
We'd better leave it there. Peter, thank you very much indeed.
Of course. Thank you.
Peter Weed, Senior Analyst in Cybersecurity at Bernstein. After the break, we're going to hear from the CEO of Flair, the discount carrier. That company has faced challenges. Customers have been complaining. He says the airline's doing business in a different way now. That's after the break. Flair Airline has come under fire from some passengers about its service reliability and lack of amenities. But the CEO says travelers should give the carrier another chance. We are joined by Wojciech Wilk, CEO of Flair Airlines. Wojciech, thank you very much indeed for coming on the show.
Thank you very much for having me. Hello, everyone.
You have a fascinating background. You are from Poland originally, and you were Chief Operating Officer at LOT, the Polish airline.
Yeah, the Polish Air Canada, as I like to call it. Indeed, I spent 10 years with LOT Polish Airlines, but moved to Canada 3 years ago, and I have the honor of leading this fantastic company, Flair Airlines.
Tell us about Flair. How big is the airline? Give us a rough idea of how many employees and how many aircraft you're flying right now.
20 aircraft, all modern Boeing 737 MAXs, about 5 million passengers, flying mostly Canadian domestic, but in winter also a lot of Caribbean, Mexican, and U.S. destinations.
Right. And how many Canadian cities are you flying at? What Canadian cities are you flying out of right now?
Well, all of them, but I mean all major ones. Okay. We have 4 key bases, which is Vancouver, Calgary, Edmonton, and then Toronto. But we cover also like a number of other Canadian destinations. But as I said, also connections down south, like opened only recently, flights to Mexico City from Vancouver and Toronto.
You have acknowledged that there's been service problems, lack of amenities, but you say that Flair is pulling up its socks and things are different. I know you don't want to dwell on the past problems, but what caused those?
Well, I mean, it's been a long and bumpy road, but I can honestly say that by right now we are a different company than some of the passengers might recall from the past. I'm proud to say that we are the most reliable airline in Canada in terms of on-time performance and completion factor. And this is not only me saying this. This is data coming from reliable independent sources. This is a true change that we've introduced to the company. It's haven't always been like this, but certainly right now we are proud to be this most reliable carrier in Canada.
Okay, I hadn't seen that data myself. So tell us, who owns the airline now? Can you just describe who are the basic owners?
Well, this is the rather wide portfolio of Canadian and U.S. investors. Overall, Canadian investors hold about 65% of all ownership, and American investors 35%. There's been some shareholder changes this year. I'm happy to talk more about it. But right now, this is how it looks. There is no single majority owner of the airline.
Right. Now, you are doing one thing, and you just announced this. You're saying that if you pay for a carry-on bag, you can skip the line and board with ease. We all hate hanging around at the gate. Just tell us quickly how that works. It sounds attractive.
Yes, and this is a perfect timing because we're launching this just today. So the new product is called Flair Express, and it indeed allows you for a smooth and frictionless experience in the airport from the check-in till the boarding. You get priority boarding, but most importantly, you have the opportunity to skip what's creating most friction, which is sizing your bag in the metal sizer. We recognize that this is a point of friction, but actually our ambition as a company is to become the easiest airline to fly, not only financially, but also physically and emotionally. And we recognize that this is a true point of friction. So should a passenger purchase a carry-on baggage from now on, from today, there's this Flair Express product which allows them to enjoy a very smooth, uninterrupted travel.
So, in other words, sorry, I know we can't get into all the detail, but if you decide I'm going to check the bag, I'm not going to carry it onto the aircraft, you get this priority boarding.
No, if you have a carry-on, so if you have your little suitcase together with you, nobody will bother you anymore at the gate, unless you want to bring a tuba into the aircraft, which will be a problem, obviously.
Oh, I see. Okay, but you have to pay for a carry-on bag.
Yes.
Okay,
yes. This is one of the fundamentals of the business model. So indeed, but 40% of our passengers select not to fly with any carry-on, and we also need to have a product for them.
Just finally, I know you had an interesting interview at the Toronto Star, and you said that you've decided, or the company you're not trying to emulate the European ultra low-cost carriers such as Ryanair. Just tell us briefly how your model is different.
Well, this is the major realization that we had over the last couple of years, that simply copying and pasting European ULCC model like Ryanair or Wizz Air hasn't worked in Canada and will not work in Canada, out of various reasons, starting with demography and geography of the country. We recognize the fact that Canada is an enormous country in terms of its size, while populated by only 40 million passengers, and this creates all kinds of challenges. That requires a low-cost airlines like ourselves to really become a value airline and create a product that is tailor-made for this very unique market.
We'd better jump. Thank you very much indeed.
Thank you very much. All the best.
Wojciech Wilk of Flair Airlines. Opening bells are next. There you have it, the opening bell action. At the Nasdaq, Deep Blue is ringing the bell. In New York, it's Franklin Templeton. And at the TSX, it's the CIBC Miracle Day opening the market. It's time for the first 50. Let's check in on the TSX, the S&P, and the Nasdaq as we get going. And you can see the TSX is higher right now in early trading, almost 0.5%. I'm just trying to work out how close we are to a record, 31,178. Oh, we're still quite a bit down from Friday's close, 31,382. Seeing a little bit of weakness in early trading in the United States, but of course stocks are near record highs, and some now that we're into in December, some portfolio managers must be interested in taking profits, especially on some of those internet stocks. They're off their highs, but they've been massive winners so far this year. Okay, let's have a look at a couple of stocks of interest. We'll start off naturally with the banks. Royal Bank, the giant lender, beating earnings expectations in its latest quarter. And you can see that stock is up. It's going to be close to a record high if it's not quite there. Where is it now? Almost 219. Yeah, it looks like that's a new record high for Royal Bank, north of $218. And let's check out National Bank. It has been a darling among investors. And that stock, I am wagering 174, let's call it. Yeah, new high. New record high for National Bank as well. It posted a profit beat. And finally, TELUS. It is halting its dividend growth for now. Looks like the market had discounted that. An analyst at Veritas had questioned the sustainability of the dividend, and TELUS is saying we're not going to be increasing it for now. The yield on TELUS stock, who TELUS, of course, competes with our parent company BCE, which cut its dividend this year. Right now, the yield on TELUS stock, according to my screen, north of 9%. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much. What do you have your eye on right now?
Yeah, good morning. Worth watching robotics stocks today. We've got a really interesting report out of the White House, first reported by Politico, and now we are following it because the White House apparently wants to boost the robotics industry within the United States. They had a big push earlier this year to try to catalyze more growth in AI. The White House apparently thinks that that was a very successful initiative. So they've deployed Howard Lutnick to talk to robotics CEOs and look at what potential executive orders could be in the works to, I guess, further unlock productivity there. So a handful of stocks that are up somewhat sharply this morning and worth watching. iRobot, the maker of Roombas and those vacuum cleaners that go around your house and knock things over, those are up 13%. Rich Tech is up 12%. Serve Robotics, Symbiotic, Teradyne, all of these stocks are moving. Worth watching. Tesla is also up. They have a robotics division as well. So this is a sector that is kind of worth watching today. Whether or not that executive order at some point comes to fruition, this seems to be a bit of traders front-running the news here.
That's interesting, isn't it? Apparently, iRobot also does stuff for the military, the bomb disposal.
That is interesting. Having seen my iRobot run around the house, I wouldn't want it near anything that blows up, but interesting.
What's going on in the semiconductor world?
Yeah, the semiconductor microchip is up this morning. They are the top performing stock, at least they were in the pre-market session. In the S&P 500, they had a pretty strong earnings forecast this morning, and stock is really rallying on that. In addition, Marvell Technology is rallying because the chipmaker CEO kind of dealt with investor concerns and kind of repeated the case for positive trends within the industry within its custom chip design unit. So there is a little bit of I guess, risk-on sentiment within that sector this morning. Both Microchip and Marvell Technologies worth watching today.
Somebody lent us a Roomba, and I thought my dogs would freak out, but they're steering well clear of it. They will bark at the vacuum, but the Roomba, now they're leaving that one alone so far.
Okay. Interesting. Roomba's the good guy.
And my dogs are pretty terrifying, as you can imagine. Anyway, thanks very much, Jeff.
Thank you.
Jeff Morgan of Bloomberg. Coming up, we're going to get more perspective on those earnings from Royal Bank and National. Both National Bank of Canada and Royal Bank shares trading in record territory today. National posted a rise in fourth quarter profit. It was boosted by its wealth management segments. And RBC also saw higher earnings and it's hiking its dividend. Let's get perspective from Tim Regan, Managing Director at King Weston Company. Great to see you.
Great to see you as well.
Can we start off with the biggie, Royal Bank? Anything investors should bear in mind here?
Looking through it, and it's a company we own. All I have to say is they're a well-oiled machine. The integration of HSBC has been fabulous. In all their different markets, they're doing very well. They're increasing their business. When I say incrementally, they're doing a great job of it. So nothing really pops out in this other than the fact that they're doing great and they're a well-oiled machine, and we're happy.
My brother's an accountant in Ireland, and he was telling me yesterday that he's moved all his money from a traditional Irish bank to an online bank just to get the lower fees. Is that a threat to the established Canadian banks?
Well, if you look at it, there are different banks like EQB that's coming out with earnings later on today. That's more of a virtual bank, if you will, or an online bank. But a lot of them, if you look through it, they're going to have their mortgages, their deposit bases, but really where they're growing a lot, capital markets, wealth management, RBC, and the regular brick and mortar business won't fall off. Is it going to take some incrementally? Sure. But if there's a good online bank that they see competing with them, they'll just buy them.
Yeah. Should they be allowed to, I wonder? But that's another question. Yeah. Wealth management, what a beautiful business, though, because you get fees whether you underperform the market or not.
Yes, I mean, this is a business we're in as well, but, it's been a great year. It's been a great 3 years for wealth management. And right now, I think everybody's just sitting back and looking at year end, worried about what may happen. But it's the old adage that Wall Street climbs a wall of worry.
Yes.
And that's what we're seeing right now.
Yeah. Would you put new money to work in Royal Bank?
Yeah, absolutely. New long-term money. I mean, if people wanted to, make a pass in the next year or so, who knows? But the next 3 to 5 years, Royal Bank's just going to be the juggernaut it's always been.
Right. And it does look as though the HSBC thing was digested fairly flawlessly.
Fairly flawlessly. And then, on the other side, you're going to ask me about National Bank and Canadian Western Bank, now their portion of Laurentian. National Bank seems to be doing a great job at it too. And National Bank is now getting the scale to make even more money.
Yeah, and then, of course, National has that deal to pick up a lot of the assets of Laurentian, but not the liabilities, the messy branches that they'd have to close, etc.
So it's a great deal for Fairstone and for National Bank.
Is it an oligopoly, banking in Canada?
Oh, we've always said it is, and if you look at it now, National Bank is part of the Big Six. You do have smaller banks, but they have to pick their niches. But, where else do you have a banking system where they earn, return on equity of 15 to 20%? That's pretty good. If it was a regulated utility, they'd move that down a lot. But, that's the price we pay for a strong banking system.
Yeah, it's interesting. Yeah, you pay for security in that sense because the return on equity would be much lower on their U.S. operations or return on capital.
U.S. return on equity cap in the banking business is 10 to 12%, which is normal.
What about EQB? Maybe we can put up a 5-year chart for EQB because that one has come down. There are some, they've had management turmoil, they had tragic death of the CEO, but there are some concerns about loan losses.
There are, and they've taken some. But as you go forward, as you can see, some of it is as well when it turns over, people were calling for, the end of the mortgage market that EQB plays in. We don't think that's happening. They're well capitalized. They're doing well as a business. And we think that going forward, you can look at it well beyond 100 in the next 2 years, well beyond.
How are you treating the market now? Are you, the problem often is when you get a small group of stocks leading the market higher, somebody like you, your prudence says, well, I don't want to have too much of my portfolio in there.
Sure. Well, right now, we've done a little selling, so our portfolios are about 10% cash. But how we look at it is you don't have to do anything right now. We feel we have great companies for the next 3 to 5 years at the right price, and we can just sit pat where we are today. And if something happens, we can ride it out. If something doesn't happen, we keep going up. I think today, being worried about the market is something that more and more investors do. And as that happens, counterintuitively, that's when markets tend not to implode on us.
Because people aren't piling in other words.
Yeah, it's when everybody's piling in and everybody tells you on this show that the markets are great, buy forever, then please worry.
Right. Have you got a prediction for us for 2026? Is something coming? Is there an iceberg out there, do you think?
Oh, my crystal ball. I have to get on. Yeah, it's funny because everybody asks us what's the market going to do next year. And if I came and told you 20%, people would gasp. But if you look at the markets in any calendar year, if it's up on average 20%. If it's down on average 10%. So if I was going to tell you it's up, 20 is the best guess. Not 10, but 20. So, but the true I have no clue, nor does anyone else.
No, it's the old random walk. Tim, thanks very much.
Thank you.
Tim Regan, Managing Director at King West and Company. Yesterday on Market Call, we were joined by Jordan Zinberg, President and CEO of Bedford Park Capital. The topic was Canadian small and mid-cap stocks. His ideas were Zoomed Technologies, Propel Holdings, a lender that has seen its stock drop, and Constellation Software. And today on the show, it's Kim Bolton of Black Swan Dexteritas. And yep, his focus is technology stocks. Okay, home sales down again in two of Canada's biggest cities. Lindsay Biscaya joins us after the break. Home sales are down again in two of Canada's biggest cities. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and according to experts on this, Andy, a lot of the reason for home sales being down is people actually being worried about their jobs in the future, at least in the city of Toronto. So when it comes to Toronto, which we'll start with, activity, new listings, and home sales all down for the month of November. That's according to Toronto Real Estate Board. 5,010 homes changed hands last month, so that's down more than 15% from the same time of November 2024. And that's a drop of 0.6% from month over month. So from the month of October to the month of November. And according to TREB, many households, they do want to take advantage of like the lower borrowing costs we're seeing right now, the lower prices, because prices have come down quite a bit. But people are being held back because of a lack of confidence when it comes to their long-term employment, which is interesting. We're seeing, we've seen quite a few layoffs recently within different sectors. And it seems as though people are not feeling very confident about their jobs long-term. And that's kind of holding them back at the moment, even with prices dropping. When it comes to new listings, just over 11,000 new listings for the month of November for Toronto. And that's down 4% from last year. So also a little less inventory than what we saw last year.
And the Vancouver Realtors report came out for the Greater Vancouver area, and it shows a similar drop in home sales?
It shows a similar drop, So these numbers came out as well this week, and home sales down, new listings up, though, which is interesting. But it also shows that the city is apparently on track for its lowest year of home sales in a quarter century.
Wow.
So as we know, things are priced quite high in Vancouver. Prices are coming down, but it seems as though people are still kind of holding off, waiting in the sidelines rather than buying. So there's apparently a 20% below the seasonal average when it comes to home sales. Inventory remains healthy, as I mentioned, but buyers, they have ample choice. But again, they're just waiting on the sidelines, worried about getting into housing and then not being able to afford it in the long term. When it comes to new listings, Vancouver saw a 14% increase compared to November of 2024. So that's 36% above the seasonal average. So still seeing a lot of new listings in the city of Vancouver. The benchmark price for a home, though, has come down. So in Vancouver, the price for all properties, when we're talking about a benchmark price, that's $1.12 million. So quite high at this point. But still, it seems as though buyers like sitting on the sidelines, not really wanting to just get into things just yet.
I wonder about all the thousands of real estate agents and salespeople in these cities. What are they doing?
Well, that industry boomed a lot, particularly throughout COVID. You saw a lot of people actually getting into that industry to become realtors. And I wonder that too. There's not as much demand, I think, at the moment for these jobs.
They must be working. There must be some kind of side hustle, but you're not making money selling houses, it sounds like. Thanks, Lindsay.
Thanks.
Lindsay Biscaya. Okay, coming up, we are going to talk about tax changes for 2026. Jamie Gollenbeck, he misses nothing. He's up after the break. Charities rely on donations, and they especially look for help at this time of the year. Organizations are leaning into Giving Tuesday, but fewer people are donating. CTV's Sarah Plowman has the story.
3 times a day, every day. This kitchen feeds Fredericton's hungry. A cause largely fed by donations.
We definitely need those donations to flow through this month so that we can make ends meet by the end of the year.
So far, fundraising seems strong, but costs are also rising.
We still have a large gap to go, and that gap is a little bigger than last year because, as numbers go up, expenses go up.
Unlike last December, charities are not contending with a mail strike, but rotating strikes did delay NBLUNG's mail-out campaign.
It's a bit frustrating, but really more it's the uncertainty of not knowing.
The organization says donations have slowly gone down the past few years, likely due to the cost of living, but programs push on.
Just think of charities during this time of year. We are filling in a lot of the gaps where government programs are not covering folks.
Canada Help says while Canadians are generous, 1 in 5 has not donated to a charity in the past 5 years. Last Giving Tuesday, the online fundraising hub processed more than $16 million, a record.
So we're continuing to see the momentum build, yet what we also are aware of is that the number of donors does continue to go down. So what's happening is that those who do give are giving more.
Canada Helps is reminding people that even a small donation can go a long way. And so can giving your time, something like shoveling someone's driveway, a seemingly small act of kindness that could be a huge help to someone. Sarah Plowman, CTV News, Fredericton.
As we approach 2026, it's time to check out changes from the Canada Revenue Agency. We are joined by Jamie Gollenbeck, Managing Director of Tax and Estate Planning at CIBC Private Wealth. Jamie, always great to see you. You always bring us the real goods. So the tax brackets are adjusted upwards with inflation. Just remind us of the big changes then for next year, please.
Yeah, so not a lot of changes for next year. Probably the biggest one, of course, is the full indexation of the tax brackets. So each year, the tax brackets are indexed to inflation. They've just announced last week that the inflation adjustment factor federally will be 2%. So all the brackets will be going up by 2%. The other important thing to remember is that earlier this year, over the summer, the government lowered the tax rate for the lowest bracket. That's income up to around $58,000, and they've dropped it from 15 to 14.5% for 2025, and on Jan 1st that drops further to 14% for 2026.
So that's income up to just over $58,000. You'll be at that low rate.
Yeah, right. 58,523 will be the number for next year.
Right, and then we can't go into all of it, but then from 58 to 117,000, you're at 20.5%.
That's exactly right. We go right up to that very, very top bracket federally, which is 33%, and that next year will be income over $258,000. Just an interesting point. I mean, if you look at the U.S. federal rates, with the recent Trump proposals in the U.S. that passed in the summer, their top rate is 37% federally, but that kicks in at over $600,000 U.S. dollars, which is about 880 Canadian. So just to put it in perspective, our rates, are not that crazy. We're federally, but obviously we kick in at a much lower rate than the U.S. does.
And then, of course, the provinces have to have their pound of flesh as well.
They sure do. The provinces all levy much higher taxes than, of course, the state taxes in the U.S. And, of course, we're talking to some clients that moved to Florida. Florida doesn't even have a personal state income tax, so your top rate is 37, whereas the top rate in Ontario or BC is 53.5%.
Yeah, Florida. I don't know if I could handle the heat, but I wouldn't mind that low tax rate. Yeah,
that's right.
Remind us about that old basic personal amount. This is the amount you can earn without paying any tax.
Well, that's right. So the basic personal amount, every Canadian has that. Every individual taxpayer has that. And for 2026, that number is going up to $16,452, meaning that any income up to that amount will not be subject to tax. That credit, of course, is at the lowest rate. That lowest rate is 14% for 2026. And so that credit, however, is reduced if you're sort of in a higher bracket. So, for example, they've introduced a sort of a phase out, which means that taxpayers that have a net income over $181,000, which is the bottom of the fourth tax bracket for 2026, will actually have it phased out up until they get into that top bracket of $258,000. So not everyone will get the full benefit of the basic personal amount if your income is relatively high.
And tell us what's happening with the Canada Pension Plan contributions. Are they indexed as well?
Yeah, so everything is indexed, and again, the rate is staying exactly the same. The exemption amounts have gone up. Not the exemption, but the yearly maximal pension earnings have gone up. Of course, there's two levels of CP. Those are all, fully indexed, and all that information is available readily online.
But you're earning CPP benefits on only a portion of your income. That maxes out at around 74,600. Is that it?
Yeah, exactly. So there's two levels of earnings, right? So there's the first level we've had for years. There's sort of that's what we call the second earnings level, and that number is up to $85,000. There's a sort of a second level of employee and employer contributions required, and that gives you an extra CPP2, we call it, benefit when you retire.
I didn't know this, that the self-employed people pay 11.9% CPP contributions. Quite a big chunk, isn't it? About 12% of your income.
Yeah, well, that's right. Well, if you think about it, right, if you work for an employer, like I work for CIBC, I pay my half and CIBC pays the other half. So there's an employee and employer portion. If you are self-employed, then of course you've got to pay both portions of the CPP.
Before we let you go, is there any changes to tax-free savings accounts or RSPs that we should have on our radar?
Unfortunately not. TFSAs are indexed to inflation, but they are also rounded to the closest $500. So with inflation only being 2% this year, unfortunately, that wasn't enough to put it to the next threshold. So they've confirmed that the TFSA contribution limit for 2026 will remain at another $7,000.
Right, and we should remind the viewers that first home, that newish first home buyers plan, it has the advantage of both an RSP and a TFSA, flexible, but also you get relief when you put money in. You should get your name into the system before year end. Can you remind us about that?
Yeah, absolutely. With a first home savings account, the FHSA, to be able to get the contribution room of $8,000 per year, you actually have to open up an account. So our advice is to anyone who qualifies as a first-time home buyer, meaning no home in the current year and the previous 4 calendar years, you have to open up the account before the end of the year, even if you don't put any money in it, to get the $8,000 of room for this year, which means that next year you get another $8,000 plus an $8,000 carry forward. If you waited till January or later to open up the account next year, you can only put in $8,000. So good idea to at least open the account before December 31st this year if you're a first-time home buyer.
So if people have young adult sons or daughters, get on them.
Absolutely.
Well, in my experience, you have to get on them and stay on them to get them to do anything like that. Anyway, Jamie, thank you very much. Jamie Gullenbeck, Managing Director of Tax and Estate Planning with CIBC Private Wealth. Coming up, we are going to get more on how investors are reacting to those earnings beats from Royal Bank and National. That's ahead. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Labour productivity across the country saw an increase in the third quarter. Data from StatsCan indicates that productivity rose 0.9% after a decline in the previous quarter. Manufacturing, mining and energy sectors were the main contributors to the increase, while agriculture, forestry and fishing posted the largest decline at almost 6%. The total number of hours worked also saw a decline. National Bank of Canada beat analyst estimates on profit and revenue in its latest quarter. The Montreal-based lender also posted better than expected results in its capital markets unit. This is a resurgence for the division after it missed forecasts in the previous quarter. National is set to take over Laurentian Bank's retail and small business operations in a deal expected to close next year. Enbridge has increased its dividend by 3% and reaffirmed its 2026 growth forecast. Calgary-based pipeline operator says it has $8 billion worth of projects entering service next year, and it expects strong growth from recent rate settlements and cases in gas distribution and transmission. Last month, the energy company approved a $1.4 billion U.S. expansion to boost deliveries of heavy oil. And there is a look at the there's Enbridge. Here's a look at the TSX. And you can see edging higher in morning trading. It did get a support at the open. from National Bank and Royal Bank trading at record highs. Our market, though, is still down from Friday's record high close. And let's have a look at the US markets. They are mixed today. You can see the Nasdaq slipping, the S&P 500 holding pretty steady. We have seen some weakness in the big tech stocks today. And let's have a look at oil. In the wake of OPEC's decision to hold off on the production increases early next year, China is apparently ramping up its intake of Iranian oil because it got a new import quota. Let's have a look at gold, because gold has been rallying over the past few sessions. And there is bullion north of $4,240. And of course, silver has been an incredible story this year, outpacing its bigger sister, gold. And finally, let's have a look at the Canadian dollar. There is the loonie, up slightly against its US counterpart. Shares in Royal Bank moving up after the company beat on profit in its latest quarter and also lifted the dividend. Let's get more on those results from Diana Avigdor, a VP, Portfolio Manager and Head of Trading at Barometer Capital. Thank you very much indeed for joining us, Diana.
Good morning, Andy. Thanks for having me.
Anything important with these Royal Bank numbers? Anything strike you as significant?
It was excellent, first of all, on all metrics. As expected, our premier bank in their capital markets and wealth management did really, really well. Capital markets, it's an obvious one. You just have to look at the TSX chart to show you how capital markets have done this year. And as Canada is trading at 52-week highs most days, not today, Canada has done very well, as have a lot of global markets this year. Relative to the U.S. have done much better. So capital markets, international component has done very well. But what struck me particularly great with Royal was their operating leverage of 8.1%. You recall what that is. It is how a change in revenue flows to the bottom line, direct profitability metric. At 8.1%, that is massive. Yes, the increased dividend. Generally speaking, these banks are our Canadian banks are well capitalized, so they're going to continue returning money and buybacks to their clients.
What about that low yield on Royal Bank, though? It's only 3%. And now I know they are increasing it, but compare it to, say, Canadian Natural Resources, an oil company. I know it's a special case. They have a rich dividend policy, but they're at a 5% yield.
I know, it's true. But they only started, our oil companies, actually, when you think about where oil is, we own Imperial Oil, for example. These companies are now throwing off really good cash flow. And they're very, very disciplined relative to, say, where they were 5 to 10 years ago. And that is the theme on the oil companies. And I would just say with Royal Bank or any of the Canadian banks, just look at their charts. As they go higher and higher, their yield is calculated as lower and lower. Both Royal and National increased their dividend. Maybe not by as much as you would like, but I think with a CET ratio of 13%, I think what you're going to see if they beat that, they're going to have more increased stock buyback and continued stability in increasing their dividend nice and slow.
What about National Bank? They, of course, are, now they're digesting two acquisitions, Laurentian's retail and business operations, and, of course, Canadian Western Bank.
Indeed. So their numbers were great, too. Their dividend increase, by the way, is probably lower than the market expected, would have liked to see more. I kind of understand it and forgive it. They are trying and working to increase their presence whether it's with Canadian Western Bank, which there are synergies, but maybe it's a little more nuanced there. We'll see on their call at 11 what they say. And, the Laurentian Bank portion of small business portfolio and retail, that's a nice little tuck-in. That should probably work, but it's a little more forgiven as we're going to give them the time ramp required to integrate and synthesize all these moving parts.
In the market right now, how are you playing it, Diana? Are you overweight cash, for example?
Yes, we are. So there's less than 20 trading days into year end. If you're a short-term trader, I think we're going to see increased volatility, as is normal during this time of the year. We've had a great year. Clients have had a great year. Everybody's in P&L protection mode, making sure that the volatility doesn't sink its teeth into your returns. And come another week and a half or two, liquidity is going to dry up, which makes the add-to-touch price movements a little more jumpy. So we are at around 20% cash.
Wow.
Our internal breadth indicators, have started deteriorating about 2 months ago, perhaps. The volatility, last week the market rebounded after a pretty nasty week before. So basically, if you just look at indices and you didn't look at the 2-week move, you would have said nothing happened. But a lot of stocks traveled a lot of percentages in order to show the flatness. So we'll see. If things get better, breadth gets better, we'll put money to work. But right now we have quite a lot of dry powder. And, it hasn't really hurt us, but it did decrease the volatility in the portfolios for our clients, which is probably desired.
There are fears, of course, that America's in the biggest bubble ever when it comes to this AI investment. Hundreds of billions of dollars have been talked about. Not all the money has been spent and may never be. But is there a risk that this could just make 99, 2000 look like just a mere bagatelle, and we're going to be in a much bigger blowout here?
Andy, I don't feel like we're in a big blow up. I do think that there's a lot of moving parts. Yes, the hyperscalers and their CapEx spending is now a theme. But if I step back and really step back, this AI story has a lot of tentacles. You look at employment, you look at companies benefiting, you're looking at productivity increases, you're looking at perhaps a rebuilding of the labor force. It is going to affect employment in some ways, replace. So I do think there is a lot of tentacles to this story. And one of the major ones is productivity, which offsets inflation. And so we can go on into this cycle a lot. NVIDIA reported a few weeks ago, and if they deliver on what they guided, they're only trading at 28 times forward earnings. We'll see.
I know it's fascinating times, Diana. We better jump. Thank you very much indeed.
Thanks, Andy.
Diana Avigdor of Barometer Capital Management. Coming up, Algoma Steel workers are speaking out and expressing their concerns over job cuts as the company's CEO blames Trump's tariff shock. Yesterday, CTV spoke with workers at Algoma Steel, along with the CEO of the company, who says Trump's tariff shock forced the layoffs at the steel producer. Let's get more from CTV's Scott Hurst. Scott, thanks very much. Of course, Algoma Steel cites the tariffs imposed by the White House. What's the latest for these layoffs? What's the latest from the company?
Good morning, Andrew. The company and many of its workers are placing the blame on why the cuts are happening now squarely on U.S. President Donald Trump's punishing 50% tariffs on Canadian steel, an impact effectively closing off the plant's #1 customer. So in an effort to stem the losses, Algoma says the current punishing financial picture right now is forcing its hand to accelerate retooling plans. I believe we have a clip from the CEO. Let's listen to that, and I can talk more about the transformation that is happening at Algoma Steel.
I think the government certainly knows our business strategy. It knows the pivot that we had to make. It knew very well that the extreme pressure the company was under. I don't think anybody would loan the company $500 million without asking very detailed questions about what our business plan was. I think the core concern is how do we protect the ongoing Algoma Steel? How do we make sure this company is competitive, is viable? What's the technology you're going to use? How are you going to make steel? And the jobs associated with that are an output of that.
So, Andrew, in terms of this transformation, it was something, according to the CEO, that was announced in 2021 to a new modern steel-making process and platform that does require a smaller workforce, a process that is less labor-intensive. So, according to the CEO of Algoma Steel, the plant was expecting that transition to happen sometime in 2027, but with the U.S. tariffs, those plans had to be accelerated, calling it an early pivot, really saying with so few orders right now, the company had to begin the transition, and the job losses are part of that restructuring, but brought on by the punishing tariffs, with the CEO, as you heard, saying right there, Ottawa, the federal government was aware of this plan when it loaned Algoma more than $500 million earlier this year, Andrew.
CTV News has spoken with some of the workers in Sault Ste. Marie. What are they saying?
Yeah, workers, of course, right now are dealing with the initial shock. They're still reeling. Of course, it is devastating for anyone to get the notice that your job is being eliminated, and these jobs will be eliminated early next year in March. And in an interview with CTV News, union heads are saying their members are obviously upset and concerned about the ongoing layoffs. And the steelworkers, they say, had negotiated a mitigation strategy through the process to help workers transition, with the focus notably on job retraining. But now it says workers are being let go in March without that strategy being implemented. So, of course, these cuts will have a profound impact on the company, but also the region as a whole. 1,000 job losses, by far the largest employer in the region in Sault Ste. Marie. So the impact of these job losses cannot be overstated, incredibly significant. Well, these job losses, as we mentioned, were inevitable with this retooling plan. It is years ahead of schedule, Andrew, and of course, it doesn't make it any easier.
Thanks very much indeed, Scott. Really appreciate it.
Thanks, Andrew.
Scott Hurst, our colleague at CTV News. Coastal First Nations chiefs in BC have voted against that new proposed pipeline. They say that the plan increases the risk of oil spills that could significantly affect the livelihood of local people and wildlife in the region. The Prime Minister has committed to a First Ministers' meeting with the First Nations to face growing concerns about the pipeline agreement with Alberta.
Do you respect the direction of the rights and title holders?
BC's regional chief among those with a rare chance to question the Prime Minister, as coastal chiefs are staunchly opposed to the new MOU between Ottawa and Alberta that sets the stage for a new pipeline.
I look forward to that meeting at the earliest opportunity.
Mark Carney says he will meet with the coastal BC chiefs and committed to a First Ministers' meeting with First Nations early in the new year.
Under the leadership of the Minister of Indigenous Services, this government intends to introduce water legislation in the spring of 2026.
Key on the day one agenda, an emergency resolution to maintain the oil tanker ban and a call to scrap the new MOU.
This resolution has been accepted.
It passed unanimously.
First Nations in Canada are feeling overwhelmed, that they're feeling as though the duty to consult is being undermined.
Merle Alexander is representing 2 BC coastal First Nations.
There also is a real pushback against this regression on environmental and climate change policies.
Canada can create all the MOUs, project offices, advisory groups that they want, but chiefs are united. When it comes to approving large national projects on First Nations lands, there will not be getting around rights holders.
It's bad enough First Nations don't trust the government, and this makes it even worse.
The message about a need for more consultation coming not just from BC, but chiefs across the country.
We've had enough of being excluded, and there's going to be trillions of dollars going to be extracted over the next 10 to 100 years. And for First Nations to get chump change, it's not going to happen.
The Special Chiefs Assembly continues here until Thursday. Also on the agenda, a plenary session about the Major Projects Office and Indigenous Advisory Committee. Abigail Beeman, CTV News, Ottawa.
Coming up, almost half of hiring managers say including a salary in a job posting will be an important tool for attracting talent in 2026. And Ontario is moving to oblige employers to do it, to include salary information. We'll be right back. Starting January 1st, employers in Ontario with more than 25 staff will be required to include expected compensation on publicly listed job postings. Our guest says including these pay details in the job description helps job seekers and employers save time negotiating compensation. Let's get more from David King, Senior Managing Director at Robert Half. Thanks very much for joining us. Can you remind, BC did this a few years ago, a couple of years ago, and Ontario is now doing it. Why are these provinces making this change?
That's right, yeah, and thanks for having me today to discuss the topic. It is indeed the case that BC went this way just a couple of years ago, and now Ontario in January. The need to be transparent when it comes to what opportunities will pay an organization does allow for efficiency in the employment process. What we'll see is that people who are interested in those roles will take the guesswork out of what they had to pay and what they will earn in those opportunities. And then for organizations, likewise, they're able to attract the right talent because they're very transparent about what they can expect to pay them for the job they're about to do.
That's interesting. I mean, and I must admit, say I'm shopping online. If a thing doesn't give a price, I'm clicking elsewhere. And that's going to be similar with jobs, isn't it? If you don't have a salary range, you're going to be inclined to move on.
Absolutely. I think that in the past, it was somewhat secretive as to what opportunities would pay. And it would become one of the biggest contentious points in the actual interview process, getting to an agreed number. That obviously does create internal problems as well for organizations when there are inequities that exist about what different employees are making for pretty similar work. And of course, creates competitiveness in the marketplace when organizations are paying different for, again, similar work being done.
So apparently they want to promote workplace fairness and accountability, and they want to reduce systemic wage gaps. But it must be, some employers are going to be annoyed, aren't they? They may hope to pay low wages, but it'll be harder for them to get away with it.
Yeah, I think history would suggest that there are cases and employers are trying to create an opportunity to have a very engaged and productive workforce while having to be mindful of what the spot price of labor would be. There certainly will be some organizations in the future that will have to, in the short term, reflect on any inequities that they have with regard to what they're paying historically and what the market expects. Clearly, with the transparency around compensation, you can no longer hide behind a number that isn't transparent to the market. With everybody knowing what you're about to pay, it will definitely either include great candidates because you're paying on market or exclude great candidates because you're trying not to pay on market.
But of course, existing employees will see the ad and say, well, why am I not being paid this?
Absolutely. Yeah, as soon as you post a role that has a potential job quality and value attached by way of compensation, the internal analysis will quickly take place. And so companies will have to be mindful of that. And we're certainly encouraging organizations to go through that type of internal reconciliation now ahead of the legislation to be prepared when those positions get posted publicly.
Can you give us any indication as to what happened in BC after they introduced the change?
Well, what happened with regard to the labor market increasing with regard to spot price of labor? There wasn't anything really material to suggest there. However, it certainly does help create that fairness and equity amongst positions in the labor market in that province. It also does help create a sense of trust with the organizations and leadership because they're no longer trying to hide behind a number. It is a very transparent exchange of a contract to suggest that for the work we're asking you to do, here's what we're about to pay you. And so I think there have been ancillary benefits in the market, but no study would suggest that the actual price of labor has gone materially in one direction or another because of the legislation.
They also, the Ontario's bringing in a thing that would prohibit a Canadian experience requirement. And apparently this is aimed at opening doors for internationally trained professionals.
It's meant to create objectivity around what the job actually requires to be done and if you have the skills to do that, excluding any detail around where those skills may have been gained, whether it be in a Canadian opportunity or elsewhere. So it does take away the inequity that potentially could occur if an employer was suggesting there was a preference of which country that experience would have been gained in, therefore creating more objectivity and, again, more equitableness amongst the labor market.
Interesting change here that employers will have to, if they interview someone, they have to get back to the person within 45 days to say whether a decision is made. There's a lot of companies don't even bother. They're behind getting back to candidates even after interviewing them.
Yeah, absolutely. And it really happens on both sides. Sometimes you will see candidates who are no longer interested and simply disappear from the process. And you also see clients who do the same thing. So the requirement now for a 45-day window by which a company has to follow up with anyone who they've interviewed to provide direction on what happens next, whether they got the opportunity or not, and to document all of that process, both the interview process as well as the follow-up process. So this is creating more documentation and oversight requirements for HR functions in organizations.
And they have to disclose to the candidates that AI may be used in vetting applications.
Yeah, we certainly see organizations today, especially if there's a large volume of response to a potential opportunity, to use AI to vet based upon keywords that are required for the role that they're looking to fill. And so if this is happening, it now will need to be disclosed as well to any potential candidates that AI is being leveraged in the vetting process.
There's kind of a technology war going on because applicants are using AI as well to bombard. I think some applicants are just mass mailing out applications using AI.
Absolutely. And what we are seeing as a result of that is a lot of organizations are now suggesting in-person interviews are coming back in vogue, making sure that they can properly assess for themselves in the flesh exactly who they potentially are hiring, so that there's no concern that AI has played a material role either on the employer or the employee side of that engagement.
David, thank you very much.
Thank you for having me.
David King, Senior Managing Director at Robert Half. Coming up, Laurentian Bank is selling itself in two parts. Privately held Fairstone Bank will buy the actual company for $1.9 billion. Stockholders are getting taken out at a premium of about 20%. National Bank acquires Laurentian's retail and small business assets. We heard from Eric Provost, CEO of Laurentian Bank, and we'll bring you that conversation after the break. Shares in Royal Bank hit a record high earlier, now slipping slightly. The company did beat on revenue and profit expectations in its latest quarter, driven by strength in capital markets and wealth management. There were also strong results in personal and commercial banking, and the dividend is going up by 6%. Shares in TELUS moving higher. The telecom company plans to pause dividend growth. It is going to continue to pay its current quarterly dividend. TELUS says the pause will remain until its share price reflects the company's growth prospects. The Vancouver-based company also announced a new 3-year free cash flow target growth target of 10%. Home sales and prices across Toronto saw declines last month. The Toronto Regional Real Estate Board says sales in Canada's biggest city were down nearly 16% from the same time last year. The benchmark home price also fell nearly 6%. Tariffs imposed by the U.S. are said to be deterring some consumers from making big purchases. There is a look at the North American markets. That's interesting. The NASDAQ now turning, just as I said that, it went negative again, but it's not really much of a move in either direction. Just looking at the big traders right now in the United States, Tesla is higher, Nvidia is down, and it's an interesting headline on Bloomberg here. Amazon rushes out latest AI chip to take on Nvidia and Google. So Amazon is now supplying chips. Okay, it's fascinating how these internet giants are mutating into hardware suppliers as well, or certainly device suppliers. Just checking on Royal Bank of Canada, we saw that the stock has turned down slightly. Maybe we could put up a 5-year or a 10-year chart. But the stock did get to, December 3rd. The shares did hit briefly anyway, a record high today. And they've been more than double in the past 5 years, excluding dividends. So Royal Bank trading in record territory. Can we just put up a 5-year chart for Lundin Mining, LUN? Because that stock, that copper stock popular with investors, LUN, the shares hitting their highest in at least a year today. And there it is, moving up. Copper, of course, near record highs. We're also seeing quite a few gold companies moving up. Maybe we could put up Allied Gold. I think the symbol, I'm not sure if we have this chart, is AAUC, but a whole bunch of energy companies and precious metals companies hitting their highest in at least a year, and in some cases hitting record highs. Investors buying into the resource names today. Paramount Resources is hot, Seabridge Gold, and Taseko Mines. Laurentian is selling itself in a two-part deal. Privately held Fairstone Bank buys the actual company for almost $2 billion. And National Bank acquires all of Laurentian's retail and small business assets. We sat down with Eric Provost, President and CEO of Laurentian Bank, and got more.
We were looking for partnerships and ways to actually be able to move away from the big banks model and focus on our strength, which we strongly believe is commercial banking, and we've been quite good at this over the years. So it landed this way because we developed quite a good rapport with Fairstone Bank, and the outcome for our retail customers lending to National Bank is actually great, because another very solid Quebec-based bank, and that will offer actually our customers a broader scope of product, and more importantly, much better technology in terms of banking tools.
So the Laurentian brand itself will be kept, is that correct?
Yes, and that's another great news for us today, is that we will operate under the umbrella of Fairstone Bank as a subsidiary. I get the privilege to continue and lead that great team based here out of Montreal, and we'll continue. Like, this opportunity for us is amazing, because we'll be able to continue and grow in segments where we exceed, and I believe this will create even more opportunity for us in the future.
That being said, your branches in Quebec under the Laurentian Bank name will close. How many employees will lose their jobs?
Yeah, that's the sad part, and there's always a component in those strategic decisions that makes it so difficult. But at the end of this process, and again, like not as of in the upcoming period, like this needs to get approval by our shareholders and the regulatory. But at the end of the transition process towards National Bank, we'll be closing our branches here in Quebec, and about 700 people will be impacted by this decision of restructuring our retail activities.
Yeah, so quite a few. Okay, there were challenges of being a smaller bank operating in Canada. Can you explain one or two of the bigger challenges you faced?
Well, actually, I think it's related also to our positioning, being a very focused regional bank here, as well as the lag and gaps we add in terms of technology, and really the fact that we weren't able to attract new customers, and the investment required to equip ourselves with the right tools on a digital front. And that did not justify the investment and the return. So like I said from the get-go, at our strategic plan, we really wanted to focus more on our strength, and this transactions allow us to actually accelerate this plan.
You were looking for buyers about 2 years ago. Were either of these companies, either Fairstone or National, interested at the time?
I won't really come back on the process. Like, we all know, it didn't land anywhere, and we got to where we are today. I'm very, very happy with this conclusion because, as I said, and I'm reinforcing, like, if we were to be acquired by a large bank, I believe it would have been the end of a great institution, 180 years close to existence here in Quebec. And I think Fairstone recognized the brand, recognized the value there. And for us, it's a new chapter. We're turning a page today, but definitely opens up for a great future for this organization.
You need the 2/3 support of shareholders. What have you learned from shareholders so far about this deal? Whose support do you already have?
Yeah, well, our biggest shareholder, Caisse de dépôt, CDPQ here in Quebec, that has been a long-time shareholder and big support of us, has agreed for voting support in favor of this transaction, which is major for us, and send the right signal that this is a good transaction for our shareholders.
Have you heard from other shareholders?
Well, no, not directly, but the most important one is definitely CDPQ for us.
So what does this mean for bank clients, individuals and commercial clients? If you could just explain the way forward for them.
Yeah, so for our clients, the message is you have nothing to do. Like, we are going to take care of the transition, the migration, working with National Bank to make sure that it's an easy and simple process. So no actions. And by the way, all our operations are continuing as they were before. Like, our people are in the branches. We now have a page on our website that is dedicated to Q&A, as well as a dedicated phone number for customers to reach if they have questions. And please, I'd like to remember all of our customers listening, we will not reach out by text or by email and asking you to click on anything. Like, this is not the way we're going to communicate with you. And please beware, like, be careful, because some out there will try to benefit from an announcement like this. And this is not the way we operate. So please, wait for us to reach out in a way that is either paper or through our application or website, and nothing to do right now. Like, we'll keep you posted and informed while we progress towards a transition.
Eric Provost, CEO of Laurentian Bank. Coming up, we're going to check out 3 plays in packaged food and beverages with Jim Salera. Hot picks after the break. Hot picks today, it's packaged food and beverage stocks. Our guest has zero sugar energy drink maker Celsius as his top selection. Let's get more from Jim Salera, research analyst in institutional equities and research at Stephens. Thanks very much, Jim, for joining us as ever. Tell us about Celsius. What's the attraction here?
Hi, Andrew. Yeah, thanks for having us on again. Celsius is positioned in a very unique space in the U.S. right now, because what we've seen is a big consumer migration towards this focus on cleaner label, better ingredients, zero or low sugar products. And we've also seen a migration to energy drink as kind of a preferred caffeine delivery source, especially for younger consumers. And so earlier this year, Celsius acquired a brand called Alani Nu, which is more of a female-centric brand paired with its core Celsius brand, and then recently also picked up the Rockstar Energy brand. And so they have a pretty targeted portfolio that really expands the aperture of consumers that will come into the energy category. And we've been seeing them really drive incremental visits and incremental trips to the energy category because of the zero sugar kind of health forward brand positioning.
Tell us about your next one, Vita Coco. The core of their business is coconut water, and that striking a chord with consumers?
Yeah, so again, kind of pulling on that same thread around health and wellness. Yeah. Vita Coco, organic product, pretty much as natural as you can get. Crack the coconut open and water comes out, and that's the product that you're consuming. Earlier in the year, there were some concerns around tariff impacts and what that might do to the business. But as we've seen recently, the Trump administration has put in exemptions for a lot of food products, coconut water being among those. And so that's dramatically improved the margin profile for the business moving forward. And we've also seen, major retailers like Walmart increasing their shelf placement for better for you beverages, including coconut water and Vita Coco in specific. And so when you have large retailers increasing the shelf visibility, that drives more eyeballs and gets more consumers to try the product and, add it into their kind of routine shopping behavior.
Apparently, there has been a lot of hype about coconut water, but it's not bad for you, but it's not especially good for you. I don't know if it's particularly nutritious either.
I think it depends on what you're substituting. So what's the use occasion?
Right.
So, if you think about coconut water as kind of a natural hydration beverage versus, a sugary sports drink or something like that, it does reduce the amount of sugar, and particularly you're substituting natural sugars versus artificial sugars. So like all things, it's a comparison of what you're replacing versus what you were consuming before.
So you say, I think you touched on this, you reckon the valuation is rich, but you think it's justified in this case with Vita Coco?
Yeah, so I think right now in consumer, given a lot of the dynamic around kind of lower income consumer pressure in the US, there's not a ton of growth opportunity. And so what we found is all of the brands, so we touched on Celsius earlier, Vita Coco, another one, if they're in this momentum basket and they're seeing more engagement with consumer, potentially replacing legacy brands that the consumer was previously buying, that allows them to command a much more premium multiple relative to the rest of the group. So it's a small selection, but we think that, if you're in that momentum basket, it allows you to command a premium versus, kind of the broader group.
I notice if I go into a corner store or a convenience store, there's a fridge and it's just full of beverages from the giants, Coca-Cola and Pepsi. I think they supply the fridge in some cases. So is it hard for these smaller brands to get into an outlet like that?
Yeah, so that's a great point. And yeah, Coca-Cola and Pepsi, as long as KDP, Keurig Dr. Pepper, have big direct store distribution networks where they have employees, going to these convenience stores and other outlets and filling these refrigerators. Celsius actually has a distribution agreement with Pepsi. And so that allows them to kind of piggyback off of that much larger network. And so you'll often see Celsius in those branded Pepsi coolers alongside, other Pepsi products. And so it provides a kind of insulation for a brand like Celsius, and does create a challenge for some of the smaller energy brands to really get that same kind of on-shelf presence if you're not riding with one of the big distributors.
And then finally, Zevia, which uses that sweetener stevia, or stevia, I forget how to pronounce it. Tell us, again, this feeds into the thesis that consumers want stuff they see as healthier.
Yeah, so again, kind of common theme across all these guys. Zevia is zero sugar soda, really priced at a much more affordable price point versus what we've seen from some of these other kind of functional, better for you soda. It's much more comparable with kind of a traditional diet soda in terms of price point. They actually just signed a deal to expand into Walmart Canada. So if you have any viewers that are shoppers at Walmart, they should see this appearing on shelf in the not too distant future. But again, we've seen a lot of retailers, Walmart in particular, take a leadership role in expanding the shelf presence for these zero sugar beverages. And in our view, that's kind of an indication of things to come. You know, if you have the world's largest retailer adding more allocation for these zero sugar beverages, I think it speaks to kind of the durability and in the long-term trend that we see with consumers, you know, guiding towards these healthier options.
Jim, thank you very much indeed. Jim Solera, research analyst in institutional equities and research at Stephens. Coming up, we'll take one last look at the markets before we go. Know Your Options is back. Tune in today at 3 p.m. Eastern to get your option trading questions answered by Chris Tom of Moat Financial. Send your questions right now to knowyouroptions@bnnbloomberg.ca. And let's check out the markets. We'll have a quick look at the equity indices. The Nasdaq pretty flat, the S&P pointing up about 0.1%, and Toronto boosted by, well, there were gains earlier in the bank stocks. Investors like the look of the numbers. Royal Bank, though, as we saw, giving up its gains, but it hit a record high this morning. So shareholders have nothing to complain about, but I guess humans always find something to gripe over. Let's have a quick look at oil, see how it's doing. There are hopes, of course, that the violence in Ukraine will come to an end, and that could be bearish for oil if it releases more Russian oil onto the global market. Let's have a quick look at gold. Gold has been rallying over the past few sessions, but it's been left well in the dust by silver. There are gold futures north of $4,250. Not sure if we have time to put up silver here. Looking at spot silver right now above $58.50 US an ounce, and spot silver has doubled in the past, so far this calendar year. It's up 103%. Gold in the calendar year, spot gold up about 61%. One stock out of favor right now, Boralex, the producer of renewable energies, especially wind. That stock hitting its lowest in at least a year today. Q3 was marked by challenging weather conditions. Their underlying profit slipped year over year and missed estimates. However, Raymond James is sticking with a buy on the stock, saying they have a pipeline that is pointing to growth, and they have a wind farm in Quebec has just reached commercial operations. We'd better leave it there. Thank you very much for joining us on the Open. Morning Markets is next.